in the next 2 to 3 years, insurance is going to have a strong impact on the way that we think about investing in multifamily properties.
What's up, guys? Welcome to another episode of Invest Iowa. Today, I have Rich Bales with me, and he's going to give me a class on insurance. And mostly very and strongly interested in how that is going to affect multifamily real estate, commercial real estate in the Midwest. So areas such as Des Moines, Iowa City, you could talk about the Midwest, Kansas, Missouri, all those places in general. Thank you so much for coming, Rich.
Yeah, for sure.
Looking forward to having my brain imploded with ideas. If you could give us like a brief introduction of who you are, how you got into real estate, and what you're working on, that'll be great.
Yeah, for sure. So I'm Rich Bales. I'm with Phillips Stafford Insurance Group based out of Des Moines here, but I'm an insurance broker that covers the entire Midwest. So everything Iowa and essentially surrounding that. But my background a little bit is I was actually in medical device sales for 10 years, hired out a team across the Midwest, was working on that. And then as I went, started investing in real estate with flips, rentals, stuff like that, BRRRRs, all that good stuff. So got attached to that pretty early on, and then eventually made the move over to insurance and was living in Des Moines. Thought, what better way for me to get connected with the real estate community than being in insurance, where all of my connections are people that are financing the deals, that are finding the deals, they're the contractors working on the deals. So this business just really meshed well with my goals in real estate as well. So that being said, that has kind of teed me up to where I'm at in my career now, where, I've got the option to go in all these different directions with insurance. Every business, every person, everything in this world needs insurance. But, with my passion kind of lying in real estate, I'm trying to sort of narrow that down where I can say, hey, if this applies to real estate in some way, I want to have my hands in it. So it's continuing to learn and continuing to dive into that and just expand my network. I try to sit down with somebody every day, whether it's a coffee or a beer or lunch or whatever it is, and shake a hand, meet a new face, and hopefully, be a resource for people as they're growing their teams and growing their real estate. So,
How walk me through your introductory, consumer-friendly description of how real estate relates with insurance.
Yeah. So, I mean, the most basic way to think of it is if you own any sort of real estate, whether it's a store, whether it's your personal home, whether it's an apartment complex, whatever it might be, you have to have insurance on that. I guess technically you wouldn't have to, but if you have a loan on it, you absolutely have to have it. But even if you own it outright, it only makes sense to have insurance. It's what's protecting you in the event of a major loss. So, probably the easiest way for your average consumer to take this is, let's say you've got a house worth $300,000. You can pay $1,000 a year to have insurance on that says, if a tornado comes tomorrow and wipes my house out, it's going to be rebuilt brand new. All the stuff that's in it is going to be replaced. You can have peace of mind knowing that financially you're not going to be completely ruined from that.
Okay.
So, and that same thing translates to, now all of a sudden I've got a $20 million apartment complex. Same thing. If a fire takes that out, the goal is that doesn't completely bankrupt your business and you've got the ability to continue moving on. So,
how do those insurance differentiate from residential to commercial?
Yeah, so there's a lot of differences. One, just the sheer volume of what we're insuring, right? So, if a house is $300,000, that's one thing, but if an apartment complex is $20 million, that's a totally different thing. Things we're looking at then is, if you've got a 100-unit apartment complex, you may have $5,000 worth of appliances in every unit, right? So now all of a sudden you got to make sure you're factoring that in. You've got monthly rents that you're counting on. So now if your apartment burns down, not only are you out the actual structure, you've got monthly rents that your business was relying on and that investors were relying on coming in. So you got to make sure that the rent is insured as well. And just that being said, the losses are a lot greater with a large apartment complex, stuff like that. So, if an apartment unit burns down, that can be, as I said, $10-15 million loss. So for insurance companies, it takes a very different appetite to insure commercial real estate than it does for residential stuff. And that's an ever evolving market as well, especially with, we touched on it a little bit prior to this, but just with the weather changes that have happened in the Midwest, it's gotten a lot harder to insure these things because the losses are getting greater.
How come? How come? But
Yeah. So there's a handful of things that go into it, but from we'll start macro and work our way micro. But if you look across the entire U.S. right now, the amount of losses that insurance companies are seeing are going way up, and that's a combination of wildfires affecting things in the West. There's hurricanes in the Southeast and on the East Coast that are really impacting things, and then right here at home in the Midwest, we've got all these wind and hailstorms that are now hitting much more frequently. They're hitting harder. All those different things combined with the fact that 2-3 years ago COVID hits, and all of a sudden labor gets way more expensive, all of a sudden materials get way more expensive. So kind of just that culmination of all these different things has led to the average cost of a claim going up and the frequency of claims going up too. So not to get too nerdy, but insurance companies are limited on how much they can raise a price each year. And so
wait, hold on. Is this regulation state regulation, federal regulation?
State by state. Yep.
Okay.
So, I'll make the numbers really easy, right? So let's say you've got a homeowner's policy you pay $1,000 a year on, right? And this year your roof and your siding get taken out and it costs $20,000 to repair it. Okay, that insurance company, if they're charging $1,000 a year, isn't going to make money on you for 20 years. Now, okay, so now you can extrapolate that, right? Same thing. If you pay $100,000 a year for your commercial apartment and you have $1 million loss, it takes 10 years before they even break even, right? So now with the weather we've had, where we're having derechos and we're having all these things, if the same place gets hit, once, twice, 3 times, all of a sudden this company's looking at going, oh my gosh, if we don't make our rates go up substantially, we're not going to make money for 50, 75 years on this place. So that's something that as anyone purchases an apartment complex, purchases a duplex, anything, insurance companies are looking at your loss history and seeing, how many losses have you taken? How many losses has this area taken? They'll look at your zip code, all those different things. And that gets factored into the rate that you receive.
Okay. Well, question for those insurance, when you refer to insurance companies, there is, do you refer to the big S&P 500 companies?
Yes and no. So we work with a lot of large ones. I mean, the classic ones people would recognize are the Nationwides, the Progressives, the Travelers. All of those people recognize those names, auto owners. But then we also work with smaller mutual companies. So it just kind of depends on the situation and depends on the appetite. Some people will only take up to 4 units per location. We've got other ones that have age restrictions where if it's over 25 years old, they won't write it unless it's been gutted down to the studs. So that's a little bit of my job to be the resource for the investors going, okay, you're thinking about buying this apartment complex. It was built in, 1960 and has no updates. Well, if there's nobody in my arena that I know will take it, I know what other companies outside of it might be able to help you. And I can help guide you on, hey, this is probably going to cost you more, but there's a landing spot for it, because there's almost anything can be insured. It's just a matter of finding the right landing spot and can you afford to insure it and have your numbers still work.
Okay. And then for commercial real estate, for multifamily, let's be specific. You're saying that the rates are increasing in the amount of losses that these insurance companies are writing year by year. What's the contingency plan on the insurance companies?
Yeah, so the big things they're looking at is the natural one for them is let's increase rate, right? So they're going to try to have you pay in more money each year to help them net profit. So they look at what's called a loss ratio, which is essentially for every dollar of insurance that's paid into them, how much are they paying out each year? And for like the last 3 or 4 years here in the Midwest, most of these companies have been paying out more than is being paid in. So they're taking a loss. So step one is raise those premiums to the point where they're making money again. Okay. The other way they can do it is they want to try to decrease the amount of claims that happen. So to do that, something that you do is raise what's called your deductible. So deductible is essentially what you pay first before insurance kicks in. So historically, we could put a $5,000, $10,000 per building deductible on an apartment complex, and that's no big deal for the investor, right? Hey, I just had a $200,000 roof. We can afford to pay 5 or 10 grand and then have insurance put a new roof on my building. Good deal. But now all of a sudden, when every building in the state of Iowa is getting a new roof, insurance companies are going, we got to stop paying for roofs. We got to stop paying for siding. How do we get around some of these claims? So instead of having that $5,000 or $10,000 deductible, they're looking at what's called the TIV, which is total insured value of the building. So what that is if we look at an apartment complex and said, okay, it burns down and tomorrow you got to rebuild it brand new, what's it worth? Okay, so if it's a $1 million building, they're going to go, all right, we're going to write this deductible to be 5% of that. 5% is a number a lot of them are going to. Some of them it's 3%, some of it's 4%. It's kind of all over the board, but almost all of them are moving to percentages. So if all of a sudden your deductible is 5% of 1 million, then you're looking at a much larger deductible than the previous thing. But especially as you jump up from a $1 million building to a $10 million building, now you're looking at a really large deductible where you got to come up with a lot of money out of pocket to pay it.
Okay.
So that's something that we're navigating. I've found a couple niche companies that will take and actually write a policy on those deductibles. So, on a $10 million building, if your deductible is 5%, you're paying $500,000 out of pocket before insurance does anything, right? And more than likely you can get your roof done for less than $500,000. So what we can do is we can write a separate policy, and let's say, all right, we know this is our first apartment complex. You and I decide to invest, and we go, all right, we've got, let's say $50,000 each set aside that we can do stuff with, and then we're going to syndicate this deal, bring in a bunch of investors. We do it. Okay, we know if 2 months into this thing, a hailstorm completely annihilates our building where we need new roofs, we need new siding, all that stuff, we cannot come up with $500,000 and stay afloat. But if I look at this and go, okay, I can write this separate policy on this that says, we decide, all right, we're comfortable with paying $40,000. Okay. So I can write a policy that will take that deductible from $500,000 down to $40,000. And, we might pay an extra $20,000 a year to bring that deductible down. But guess what? Between our investors, between increased rents, stuff like that, we can sustain taking $20,000 across 12 months, but we can't sustain a $500,000 loss. So
Okay.
The other benefit to that too is like in that scenario, so the loss is $300,000 or $400,000. It falls under that $500,000 deductible.
Yeah.
Now you're not having a big loss on your initial policy. Now it's just going on this other separate little policy. So like I said, when you go to shop your rates around or look at a different company, they're not going to see, wow, there was this big $400,000 loss on your normal policy.
Yeah.
So it protects your loss runs a little bit too, which I think is going to be a bit of a long game here because everybody's going to have losses. So the less we can have on those policies, the better off we're going to be long term. So it's one of those things. It's the complicated, nerdy side of insurance that people just haven't really had to worry about. But that's something where I'm thinking about it every day. It's like if I'm going to provide value to these people, I kind of have to tee them up because we could be 2 years into this thing, and all of a sudden, if nobody will touch it because there's been 3 or 4 hail claims, and some of them are for 50,000-60,000 that probably didn't need to happen, and nobody coached them, then it could really wreak havoc long term. So
in that case scenario, let's place ourselves in worst case scenario, in which, well, first of all, do you think insurance premiums will ever get too expensive for a commercial deal, a multifamily deal, to not make sense?
I definitely think there will be some that won't. I think there's a lot of deals that are tight, right? I mean, especially now, rates are up. There's a lot of different things pressuring the market. Labor's way up. A lot of investors are looking for value add deals right now. So a value add now versus 5 years ago, you're going to pay a lot more for the materials. You're going to pay a lot more for the labor.
Yeah.
Now, depending like what your strategy is, if it's short-term versus long-term hold, that type of thing, If holding costs go way up with rates, that squeezes numbers too, right? So,
Yeah.
um, if you went from planning on $400 a door and now you're looking at 800 or $1,000 a door for insurance, that's a pretty substantial impact if you have a lot of units, right? So, um, on 100 unit apartment complex, that's the difference between, $40,000 and 80,000 or $100,000. So, insurance alone could have swung that deal a difference in 60 grand from a couple years ago to now, which is a pretty substantial amount of money.
That
You
do you
know, and
think that's do you think that's gonna happen though? Like,
it is happening. Um, it's happening right now. We're seeing it all over the place. Whereas like typically, like I was just kind of like a background, like box to check on these. Now I'm having people ahead of time being like, hey, this is a property we're looking at. Can you try to do some underwriting on it just to see where we're going to end up, because it's going to be tight. There are obviously some of these deals that are no brainers and the numbers are going to work no matter what, because
right.
it's off market. It's going to be a home run. We're going to hold on to this thing for 2 years and we'll be out of the deal, right? But there's other ones where it's like, I don't know anymore. This is tough.
Right. Who do you think is gonna be the most affected in these type of scenarios? Your big investor with 100+ doors, or 100 and less? Your typical like have two duplexes, eight plexes, things like that.
Yeah, I mean, the ones doing the smaller duplexes, eightplexes, they should be fine. I mean, maybe if you're like a first time investor where you don't have any extra capital, anything like that, like it might be a little bit scary in those situations. Um, the ones who I do think will strongly be affected are the people making that transition from, maybe doing duplexes and single family homes to getting into their first multifamily deal. But for them, it's not like they've got all this equity built up in a bunch of other places that, worst case scenario, they've got a way out, right?
Right.
These people who are buying an apartment complex every 60 days, every 90 days, they've got access to capital, they've got access to all these other things where they can self-insure to a higher limit. So for them, it's like, if we put $50,000 deductibles on something, like that's fine. We've got 50 grand that we can throw at this stuff. We've planned CapEx for the last 10 years. We've got reserves. It's the people who are walking into this and going, I can't have a deductible higher than $20,000 because I don't have more than $20,000.
Yeah.
And I would have to go fundraise to like pay my deductible. Those are the people that aren't going to be able to do these deals,
Okay.
unless they do it well. If they really know their stuff, they probably can, because they'll build it into their syndications and stuff. But yeah.
You need to go see your baby.
No, my wife just brought her downstairs. I heard her kind of crying.
Oh, okay. That's fine. That's fine. That's
Yeah,
fine.
yeah, we're good.
That was just gonna bring me to what are the investors worry about? Like when you have conversations with these people, what are the questions that are arising from them?
Yeah. So I guess I don't know if this answers your question right, but like the things that I'm talking to investors about are, one, age of the building. Like that's something you should be actively paying attention to when you're
Oh,
buying
this is
these.
interesting.
Yeah, you need to know the age of the building. Once you get beyond 25 years, it gets tough. Your rates are going to be higher on buildings that are over 25 years. And ultimately, if people aren't asking you these questions ahead of time, that's also a problem, because we can like sneak stuff past underwriting, but that's not to be said that like once a claim happens, when this gets figured out, that it's not going to like be a problem with your claim, right? So I'm always really upfront, try to like really dig into the details. You want to pay attention to when was it built. You want to pay attention to if it's sprinklered or not. And this is me kind of sticking to the like apartment complex side of things.
Yeah.
Is it sprinklered or not? We're looking at like, do you have a property management company? That's a benefit. That's something that insurance companies really like to see, especially once you get over 10, 15 units.
Really? How
Um,
come?
and that's just because now they're no longer like, the liability gets off of you to make sure that like sidewalks are scooped and all of that stuff. Because if you're self-managing and you're the guy who's going to go out and like put salt down and plow the drives and stuff like that, because like the other piece is, slip and falls are a really common thing for commercial real estate. And those can get pretty expensive, especially if you were negligent and didn't get out there and clean the sidewalks off, right? So if you have property management involved and they're taking care of those things, they're switching out locks after people move out in a timely manner, all those different things. They're cleaning things well. It just protects you and takes some liability off of you as the investor. So for bigger things, insurance companies definitely like to see that. Other things they're looking at is stuff like, what's your plan for fires other than sprinklers? Do you have hardwired smoke detectors? All that type of stuff. What's the age of your roof? Once you get past that like 10, 15 year mark,
Okay.
they are going to start going to what's called actual cash value on roofs. You're going to see that more and more. And that's just essentially looking at like the depreciated value of your roof, right? So, a brand new roof, let's say it's worth, I don't know, $50,000. After 15 years, that thing's been beat up. It's been hit by a bunch of hailstorms, kind of starting to fall apart. They're, I don't know, that thing's probably worth 20 grand now. So if you have a claim, they'll pay you the 20 grand and say like, all right, you're on the hook for the other 30 if you want to put a new roof on it. Yeah. So that's something. Another thing that I'm starting to see more companies roll out is what's called a cosmetic exclusion. So for years, when people would have hail, if it just put dents in things but didn't ruin the structure of it, companies would be like, yeah, we'll put a new roof on it, we'll put new windows in, new gutters, new everything. Now they're saying if it's cosmetic only, we're not going to do anything. So it's up to you. Like that's another piece where, metal roofs are becoming more common, but metal roofs are like prime targets for cosmetic exclusion stuff because they get dented up. But a lot of times it doesn't affect the structure, right? So I'm asking the materials on the roof. I'm asking for, when it was updated. They do care about stuff like, when was the last time you updated like the HVAC stuff, whether it's a boiler, furnace, whatever it is. If it's an older building that was built a long time back, they're going to want to see like electrical updates, plumbing updates, any of that stuff. That's all stuff they factor into your rates. So really like what they're looking for is if every insurance person had their ideal client, it's gonna be a brand new build with all new everything with no losses. Like that's like the perfect client, right? Like that's the easiest. It's gonna go smooth through underwriting. There's no losses here. Everything's new. We know there's nothing sketchy because essentially the older that building gets and the less updates there are, the higher likelihood that something goes wrong.
Right. That completely makes sense. So the
Yep.
age, this is super interesting, dude. I mean, the age you said was a big one. The roof was a
Yep.
big one. The sprinklers.
Yep.
And what other systems they have over the sprinklers and the property management. That'll be like the 5 main tickets that they will look at.
Yeah. Yep. Exactly. And then I mean, like I could go on forever, but they're looking. Is this student housing? Is this are there elderly? Is it government subsidized? Like what all is going on in here? At some point, we're going to have all those discussions and know all those details. But, if I was going to write down on a napkin, like you're going to look for a deal today, like pay attention to these things. I would say, how old is the building? How old is the roof? What updates have been done? Like those are the ones that like are really strongly going to influence it, are going to influence it if a company will even write it.
Yeah. In terms of percentage, how much are these the landlords in general paying for insurance on a yearly basis in terms of how much the property is worth?
Yeah, so it's a little bit easier to almost break down by door.
Okay.
And it depends by property class too, right? So, and it also kind of depends on where you're at as an investor. So if you are buying, talking about like 100-unit apartment complexes, I think that $800 to $1,000 a door range is probably like a safe guess.
Okay.
Now the higher deductible you're comfortable with, the lower that's going to be, right? So that's why I say like these institutions that are buying an apartment complex, monthly, they can put $50,000, $100,000 deductibles on this because it's no big deal to them to pay that.
Oh, okay.
Right. And so for them, their annual premiums are lower because they're taking on more risk. They're self-insuring to a higher number. So that influences it. But then, if you're doing duplexes, you're doing single family homes, I tell people roughly $1,000. You may be in that 700 to 1,300 range, but you'll be somewhere right in there. I just quoted out a quadplex last week. It came out to like $2,000. It's a single location, kind of split level. So it really depends on a lot of factors. Also, like, I mean, for the first time investors, your credit and stuff like that really actually impacts it.
Oh, really?
Because they want to know you're going to make payments and they're looking at that stuff. Your loss ratio is going to impact it too. So I mean, that's why I say, like, if I have a newer build apartment complex, um, I wrote one that I think was I want to say it's like 18 units. We wrote it for like 6 grand
Okay.
for the year. But then if they would have 2 or 3 losses on there, I bet you that would be 18, 15,
Right.
something like that. So it's it sounds complicated, but most of that stuff is on the backside, you know, by myself. But once you're kind of in it and we go through one, then like, okay, this is the stuff he's looking for, right? Um,
Yeah. Yeah, no,
so
it makes a lot of sense. What do you see now for the future of your business overall? Maybe we could talk about that, and
yeah,
as well for your predictions with the multifamily market in the Midwest.
yeah. So I will say, I'll start with my predictions for the multifamily market. I think deals are going to be tight, but I think that creates a lot of opportunity because while they're tight, I think the ones that are really good are going to keep chasing these deals, are going to find ways to get them done, and the market's not so crowded, right? Whereas like when the market's really good, that's kind of the thing that like sparked everybody to get into real estate, right? Is like, man, like there's all these deals, people are making moves, let's all go be real estate agents, let's all go do this.
Yep.
And there's 16 offers on everything, right? Whereas like when it gets tight and rates are up and all those things, there's a lot less people looking because they go, you know what, like maybe I'll just put my money in the stock market because it's safe, right? um so I think there's going to be a lot of opportunity still. I just think there's going to be more finesse to it, and having a strong financial team around you is going to be more important than ever. So having that good realtor that knows how to navigate that market and find you the right deals off market, stuff like that. Wholesalers are going to be important. Obviously, selfishly, I think the insurance piece of it's really important because it's planning for longevity and analyzing your risk tolerance and all those things. Financing, having somebody who can help you finance and get creative with that is good. So long story short, there's going to be a lot of opportunity there. You're just going to have to be skilled to do it. We're not in that layup market right now. So that's that. And then, yeah, I would say, future of my business is can continue to expand. I'm starting to look to hire, continuing to build out systems and stuff like that to be able to take on more, expand into other cities and all that stuff. And hopefully, once the insurance business is kind of on cruise control, definitely gonna start jumping back into the investing world and pick up some more properties and be fun.
Wow. Okay. Those are interesting predictions. I think I will take away the 5 major claims that you say insurance companies look at when looking at multifamily deals. I think that was the most interesting thing to me, the one that stand out the most. How can people reach out to you? How can people connect with you, work together, work with you, you working with them? How can that happen?
Yeah, for sure. So my social media is probably the easiest way to find me, just off a quick rattling my name off. But I've got everything under just Rich Bales Insurance. You can find me on LinkedIn. You can find me on TikTok, Instagram, Facebook, all that good stuff. My contact information's in there. More than happy to give out my cell phone too if people just want to shoot me a text, whatever it might be. So you can reach me there, 641-204-1619. But yeah, I'd love to connect. Like I said, almost every day I'm getting a coffee with somebody. So if you're interested, you have questions, you want to bounce anything off me, I'm an open book.
Cool, man. I appreciate your time. Appreciate educating us in the insurance world, and I'll let you know if I have any further questions for multifamily, because I'm sure.
All right. Yeah. Well, sounds good, man.
If you made it this far in the video, please hit the like button and subscribe, and I'll see you guys on the next one.